Hello, my name is Jason Hill, and my company is MSC Industrial Direct Incorporated. MSC provides industrial supplies to customers throughout the United States with its 85 sales branches, 5 warehouses, as well as their international locations. They have a strong liquidity position based on their current ratio of 2.68, which is above the industry average. The quick ratio of 1.43 is also above the industry average and further supports that position. They generated a 12% profit margin as opposed to the industry average of minus 15%. The 12% versus minus 15% is likely due to their enormous stores of PPE, which is personal protective equipment, and access to additional inventory overseas that lasted throughout the pandemic year, where most of their competitors ran out or were unable to source any at competitive prices. Because its market book ratio of 133 is considerably less than the industry average, MSC stock appears to be undervalued and might make a good long-term investment. MSC's debt-to-capital ratio is 0.36 versus the industry average of 0.29, and that is concerning, as are their sales and operating ratios, which are below the industry average. However, their margin is considerably higher, indicating room for future growth by shifting their sales focus. The company faces 2 important financial risks. As a reseller who keeps large stocks of many of their common items, they must buy low and sell high. Inflation can make that difficult. They also face a serious currency risk since many of their items are sourced overseas. Changes in the currency values can make a drill that sells for 75 cents cost $1 unexpectedly. I expect MSC to remain a moderate buy in spite of the warming business landscape for 2 reasons. MSC made a name for itself during the pandemic for being one of the few PPE sources that was able to keep items like masks and gloves on the market. COVID-19 vaccines have cooled down that demand and for this sizable portion of their business. The other was a restructuring earlier this year, taking the company from a brick and mortar and online model to a solely online model. Currently, the company is still adjusting to the new model. Both are significant changes from the state that led to the current ratings, but coupled with their consistent growth and overall stability, stock value should continue to increase and steadily through the end of their fiscal year on August 31st. MSC Industrial Direct is a long-standing industrial supply company that is generating greater than average profit in spite of possible asset and debt management concerns. They have a strong liquidity position, and peer ratios indicate they have room for growth. MSC is being undervalued and is performing as good or better than its industry peers, and its price per share is far lower. I would recommend cautiously buying MSC as the market stabilizes from the past year's volatility.